Thank you so much for joining me today. I'm so honored to have Callie Cox, who is the Chief Market Strategist for Ritholtz Wealth Management, to talk about what has been a crazy week in the stock market. So, Callie, just sort of walk us through what in the world is happening.
Well, Michelle, it's great to be here, and I hate that it's not under better circumstances, but I'm glad we're talking through what's going on because it feels like a whirlwind. There are so many headlines coming at you. There's so much speculation about what could happen on the policy front that I think it's smart to, kind of set the table before we get into what you should do with your money or how you should think about this. So, what the stock market is reacting to is this chaotic mixture of policy speculation and actual policy action, on top of an economy that's been worn down by high interest rates over the past few years. So, coming into this year, we had an okay economy. I wouldn't call it great. I wouldn't call it terrible. It wasn't really on the edge of recession. It was just okay. The job market was strong back in 2022 and 2023, but it weakened gradually into 24 under the pressure of high interest rates. And companies weren't really laying off people, but they weren't really hiring either, which is not the ideal scenario for the job market, but it's not one that you'd expect to see in an economic downturn. And I bring up the job market too because the job market is central to the stock market and the economy. Our economy, 70% of GDP is consumer spending, and Americans spend money when they're making money. Many of us make our incomes from our primary jobs or primary employment. So coming into this year, the job market was okay. There were a few cracks that were worrying. But now, with all of this policy speculation, with these new tariffs that have come into effect over the past few weeks, and with the layoffs that we've seen in the federal government and the second order consequences of what could happen there, the stock market is now anticipating a much harder year ahead because a lot of this could hit the economy. Some economists are predicting a recession this year, but I like to remind people that in 2022, economists were fairly certain that we'd hit a recession, and we didn't because the job market stayed strong. So don't get too caught up in the numbers that you see coming out on headlines because nobody really knows what the future holds.
Yeah.
But if we do hit a recession, my hope is that we don't. But that is the natural cycle of how the economy works. If we do hit a recession, then chances are we'll see that reflected in the stock market through prices coming down cer for certain stocks more than others. And it's unfortunately a scenario that you have to expect when you're a stock market investor. Prices tend to go up and down, and they follow the economy and earnings over time.
So when we talk about the market, the S&P 500 hit correction territory. Can you talk about what that means? And should we be that concerned that it dropped, at least on Thursday, by 10, what was it, 10%? So for regular people, right? We don't have millions. So that makes you clutch your heart or clutch your purse, as my my grandmother used to say. Because this is money what people need for retirement. Maybe they're saving to send their kids to college. And while we know those of us who do this, and you particularly, that you got to have a long-term view, it's really hard to not panic. Um, what do you say to people who are just scared right now?
Well, first of all, I would say I'm scared too. I'm sweating. I mean, I gotta admit that, a lot of people on Wall Street are sweating what's happening going on at the moment. And I'm not telling you this to make you panicky or make you more worried about the future. I'm telling you this so you understand that your feelings are very valid here. There's a lot going on and a lot that, many types of people are trying to understand. So let's back up to a correction. What is a correction? It's Wall Street's label for when a stock, an index, a security falls 10% from a recent high. It's don't get too caught up in the term. It's just a shorthand term that people tend to throw around instead of having to explain what I just explained. But it is the point, we are at the point where Wall Street is starting to label this sell-off, which should make you think about the severity of what we're seeing here. So a correction is basically a 10% drop in the S&P 500, this index of the 500 biggest and most profitable companies in America. So, we're at a point where investors are worried about the future and they're selling stocks because of that worry. But we've seen this before. We may have not exactly seen this particular scenario. In fact, these tariffs that we're seeing are some of the broadest tariffs we've seen in a century.
Yeah.
But we have been at points in stock market history before where stocks have fallen 10% or more from a high for many different reasons. In fact, since 1950, the S&P has fallen 10% or more 34 times. So that's about once or twice, or excuse me, once every couple of years on average. These types of moves happen, even though they happen under different circumstances. And we've felt this way before. I can tell you, I've felt uneasy or panicked about what's happening in the world and how the stock market has reacted to it. But I think as investors, we need to contextualize what's going on. So going back to why is this happening? What does this mean for my money? And then understand how we can process these feelings without stepping in and making rash choices with our portfolio and our wealth that we've been working hard to build over years.
So that's the key, to not act on that panic. I love that you said people should feel what they feel. Your feelings are legitimate, but it's when you take that fear to action that could cause some problems down the road. That's a great segue into, let's talk about categories of investors. Let's start with the one that is worrying people the most. You are retired. You are now withdrawing this money. You may have some fixed income, but the bulk of your money is in retirement. And this is where it gets like, and I
Mhm.
get asked all the time, should I move all my money out? That is the basic question. I can't take this. I have to live off of this money. And 10%, that's huge. So if you are retired, how do you approach this type of market where we might be heading to a recession? There was a correction. Maybe the bear is coming. What should you do? And just for those who are listening, we're not trying to give you financial advice for your individual portfolio, but just we're trying to give you a overall look of how you might handle this fear that you have. So you're retired. What did you say to those who are retired and are living off of their retirement account?
Well, I first want to say I completely understand why you're feeling anxious at this moment. You're living off of your portfolio. And it's hard to watch your portfolio value drop knowing that your income is coming from, what's that bulk of money that's being affected by everything going on in the stock market right now. I would say a few things. So, first of all, understand that you are retired, you're living off your portfolio, but assuming that you're 65, 70, assuming that you're, at early retirement age, remember, you still have decades to live if everything goes right. You need to be thinking about the long term and what's happening right now. And that's different from an investor in their 20s and their 30s who, may have a job and their primary income again comes from their employment. So on one hand, yes, you should be a little more worried and a little more cautious about what's going on right now, but you have to think about your present self and your future self. And one thing the stock market has taught us over time is that stocks are the one and one of a few paths to beating inflation over time. And inflation is the biggest risk to your portfolio, especially if you're living off of it. So take a step back, understand what's in your portfolio, know the stocks that you own, know the funds that you own. I would encourage you not to fully get out of the stock market because inflation is still that long-term risk. But if you do feel like your portfolio is a little too risky right now, think about allocating more to defensive stocks and dividend stocks, those companies that stand strong during an economic recession. I tell people all the time, certain companies rise and fall during different economic cycles, but we're always going to need to power our house. We're always going to need to brush our teeth. We're always going to need to wipe ourselves after we go to the bathroom. And there are companies that, focus on those types of products, and we call those countercyclical companies.
We've had some great years. So people see the loss now, the 10% down, but forget that last year, if you were heavy in equities, which I am for a couple of reasons, but it was up 20%. And in the year before that, it was 20 or 30%, depending on how you're investing, so it's not the loss like we think of a loss. Like you put in a dollar and now it's 50 cents. You put in a dollar, it could be $20, and now you've lost another dollar, right? Is that too simple to explain to people?
No, I'm so glad you brought this up. You have to have perspective around this. And you're absolutely right, Michelle. The S&P 500 is up almost 50%. Well, through the beginning of last year, it was up, through the beginning of this year, it was up 50% over the last 2 years. That's a huge rally. That's putting in a dollar, having a dollar 50. And if you consider that the stock market has taken a 10% step back here, I mean, that puts you at a dollar 35. So you're still up 35%. Again, feel what you need to feel. If you feel like your portfolio is too risky and you want to prepare for a recession, look at those defensive stocks. Consider dividend stocks. They are some of the more financially strong companies on the stock market. There are a lot of funds out there that are defensive and dividend funds that you can look into if you don't want to research stocks, which is completely understandable. And the other
I do
thing you
all
need to think about is
indexes. I can't do all that. That's just too much.
right, and that's okay. It's a lot of work. I actually don't do that for my portfolio. I invest in index funds.
Oh, I like that. See us ladies doing it.
Yeah, index funds forever.
I love it.
Um,
Now, would you encourage people to at least have some safety money so that it's not at risk for these big swings. So if you're in early retirement and maybe it depends on who you talk to. Some advisors say a year, some say 2 years. I've heard some say 5 to 7 years of money that's not in the market. Would you agree that that is another strategy in addition to these defensive stocks or portfolio?
Definitely. And this is the other side of the coin, Michelle. If you're living off your portfolio, you need to have a significant portion of your portfolio in fixed income. You need to be thinking about income over growing that portfolio to multiples of what it'll be, or multiples of what it is right now. And the great news for you is that it's a great time to be a fixed income investor. 10-year yields are just above 4%, which is much higher than the 1 to 2% that we saw in the 2010s, and yields are staying stable at this moment. This is a bit of a double-edged sword because if you're looking towards fixed income to protect your portfolio, knowing that bond prices usually rise when stock prices fall, we're not seeing as strong of a correlation there, but you are able to get some really high yields at this moment. And if you believe that corporate America is still strong, then you could probably depend on those yields for a while. The other part of this is cash too. Of course, cash is the safest asset you can move your money into. The biggest risk with cash is, of course, inflation. Prices tend to go up over time, and if you stuff cash under your mattress, then you're not earning anything on that cash. You're essentially losing your purchasing power. So with cash, you have to be careful. Cash is the best cushion you have against an economic emergency or a personal emergency like you losing your job. But at the same time, you take on that opportunity and inflation risk. So
Yeah.
if you're retired, if you're considering how much cash to hold, think about how much you'll need in the next year or two. Think about any short-term purchases you're making, like that beach house for the grandkids. I
Yeah.
wish.
Yeah.
And then, consider trying to make a little bit of yield and potentially investing extra money defensively in the stock market if you don't need it for those near-term purchases or needs, expenses.
Oh, that's great. So let's talk about that next category of investors, those who are like maybe 15, 20 years out, because I feel like the ones that are about 5 years from retirement, that advice is sort of similar to early retirement. But let's talk about you're
Mhm.
15, 20 years out, you're screaming, but do you need to do anything?
Well, you have a lot more agency here than you think. I know you're heading toward retirement. You're in the back half of your career, and it's scary to know that you are getting close to living off your portfolio, and yet we're dealing with all this uncertainty and seeing stock prices fall. The good news is, the stock market has recovered from every crisis that it's hit over the past several decades. And I know that's kind of hollow comfort right now because you're like, well, look at all of this going on. But hopefully you can take some comfort in the fact that those recoveries, those periods after a stock market crash that investors have had to take to recover those losses, those periods haven't been longer than 5 or 6 years. So after the global financial crisis, for example, the stock market hit a low in March of 2009, and it took about 5 years for investors to make their money back. That was a painful 5 years, don't get me wrong,
Yeah.
but you have the time horizon, even if you don't think so, you have the time horizon to make these losses back, especially if you think the stock market will fall into a correction and nothing more, which is where we're at right now. We're not in a recession. If we do hit a recession and we do fall into that dreaded bear market, you probably have some ability to buy in here and to take a little bit more risk. But again, if you're feeling like your portfolio is too risky, know what you're invested in. Maybe, sell a little bit of those stocks or funds that have done well over the past 2 or 3 years and rotate a little bit of it into more defensive stocks, into more value stocks, into more fixed income because, your peace of mind is worth it here.
So finally, the big bucket of investors, you're new to investing. You're a young adult, or you maybe in your 30s or 40s, and you finally said, okay, I'm putting my money in my 401k or maybe in a non-retirement investment account. What is this a good time? And you always hear people say, well, if stocks are down, that's a sale. So what advice do you have for those? And I love that we had a conversation in the past about being very careful about being too optimistic about like buying into the dip and doing some, things that may not work in your favor. So you've often talked about dollar cost averaging. So can you talk about that bucket of investors who are young adults just into it? And I know this because my I've got three 20-year-olds and my oldest who will be 30 actually in a couple of weeks. We got her into the stock market, not only in her retirement account, but a non-retirement account. And for the first couple of years, it wasn't doing so well. It was losing. And she was like, this is a racket. This is a racket. What? I've never lived. And we said, hang in there, baby. Hang in there. She had the last couple of years, great, extraordinary returns. Now we're back to, some funkiness, and she's still looking at us a little side eye. So, what advice do you have for new investors or people who are just wondering what is this thing that's going on right now?
Shout out to Michelle's kids because hi, you are my people. Yeah, I'm a millennial investor. This is where a lot of us sit. And, I think we talk about buying the dip, and sometimes it's a silly phrase that we throw around, but this is your moment where you can take on more risk because you have that really long time frame that you're investing for, assuming that you're investing for retirement or to build that nest egg or for that beach house that you've always dreamed about. So, take a lot of comfort in the fact that you have a longer time frame. And I'm going to make a few assumptions here, but if you're in your 20s or 30s, you probably have fewer responsibilities than you will in your 40s or 50s. So, you might also have that financial flexibility to buy the dip or confidently step in and take risks here. The other thing I'd warn about though is that you are in your 20s and 30s. This job market is okay, but it's weakening. Before you invest, take a look at your emergency fund. Make sure that if you did end up losing your job or if you did have to, find some money for an emergency expense, that you have enough cash to do that. You don't want to be investing cash that you need for short-term objectives in the stock market because these types of pullbacks can happen and we don't know how far this loss will go. So, millennial investors, Gen Z investors, this is your moment. Step in and confidently buy the dip. But Michelle, I would just like end on this note because this line that I'm about to tell you is what gives me comfort every single time I feel my brain running away from me in this moment. Cycles of joy and pain have been the heartbeat of the stock market for decades, for centuries. We've seen that over and over again. And history isn't gospel. I know that, but being a type A person who loves numbers, I love thinking about the fact that over the past 70 years, we've gone through wars, we've gone through humanitarian tragedies, we've gone through 13 recessions. We've gone through a global financial crisis where everybody thought the world would explode. We went through a pandemic. We went through the dot-com crisis. Yet the S&P 500 over 75 years has returned an average of 8% annually. Even though we've gone through I think it's 12 bear markets and 23 corrections of prices falling 10% or more. This is how taking risk works. And I know that can feel scary, but for me, that provides me a lot of comfort. We've been here before and we've felt this way before. And we've made it through because society is resilient and humans build back better every time.
Kelly, thank you so much for joining me. I love talking to you. I love the way you think. And you've been so helpful to my readers. And I just know we'll be talking more in the future as this market does what it's going to do.